Hi, I'm Tom Lydon, editor of ETF Trends, and I'm here in Chicago at the Morningstar ETF Conference. And I'm here with Steve Cohen, Managing Director of Proshares. Steve, great to see you.
Good to see you, Tom.
You guys just had a new announcement on a product line that was pretty innovative. Tell us a little bit about it.
We call these products the X-Sector products. So there are 4 of them now, S&P 500 products that remove a single sector, energy, healthcare, technology, financials, from an overall allocation to the S&P 500.
So, for example, earnings have been pretty good for the S&P 500 except energy. So if you felt that that was going to continue on and you wanted to buy that S&P 500 allocation, X energy, you've got that within an ETF.
Right, and let's just say, for instance, you were heavy up on energy through sector funds or through an allocation to other S&P products that might have an overweight to energy through an active manager or through another product that you own. Here's a way to actually continue to invest in the market, but underweight the exposure by removing that sector from your allocation.
In talking to the CEO, Mike Saper, he said also you get a lot of these ideas from talking to advisors, and advisors kind of brought this idea to you folks and you folks put it together. One example he also gave is somebody works in a technology company and they have a lot of company stock. And so they're already overweight from a technology standpoint. Buying the market X technology might be a good move for them.
That's exactly right. And you know, this is a strategy that's been used in the separate account world for years. Like you said, somebody who's invested in the financial services industry because they work in the financial services industry, have company stock. Here's a way to, again, underweight but still invest in the S&P, reduce your exposure to something you may be overexposed to already.
Yeah, you folks have just done a great job of being able to encapsulate strategies within one product, with one ETF. And before I let you go, we know that the Fed is at one point in time going to pull the trigger on hiking rates. You've got a great strategy within a interest rate hedge vehicle where it's actually long corporates or long high yields. It actually has a short treasury and short duration component.
That's right, because you know, one of our strategies here is really to tailor exposures, let investors, financial professionals have the flexibility to remove certain risks from a portfolio. So if you want corporate or investment grade or high yield exposure, but don't want to have exposure to interest rate moves, especially interest rate moves on the upside, here's a way to remove that risk from a portfolio and still get the exposure you're looking for. And it's the same thing with, you know, currency hedge products that we introduced, removing the currency hedge. So we have, you know, more tailored exposures for investors that give them more flexibility to do things they want to do.
Excellent. Steve, great seeing you. Thanks for coming by.
Great seeing you too, Tom. Thank you.